Well, welcome to the first of our Finance for Expats webinar series. This one, Investment Guidance and Considerations for Expats in the US. This webinar will be presented by Robert Hoey of SJB Global. And this webinar will offer insights and guidance for the smooth transition to life in the US and explore opportunities and challenges of investing in the US market. So anyway, before we start, I'd just say that we are here to answer any questions you may have. So please submit your questions using the link on your screen. We'll answer whatever we can during the session and follow up by email afterwards for any that we might have missed. And for those of you watching a recording of this webinar, please send any questions to me at Expats@Expat Network, and I will either answer your question or find someone who can, which will probably be Robert. So let's get started. Robert will take you through his presentation, but first of all, could you perhaps start off by telling us a bit about yourself and SGB Global? And over to you, Robert.
Yes, thank you, Nigel. Welcome everybody. Good morning, I guess, to those that are in the US, and for those that perhaps aren't in the US at this present time, good afternoon. I'll be your host for today, as Nigel said. My name is Rob. The company that I'm representing is SJB US and Global. We essentially specialize in the kind of cross-border wealth management space for individuals in the US that have perhaps migrated there from the UK and are looking for advice on their domestic and overseas assets, and just perhaps highlighting some of the issues that they may face. Company SJB was actually set up in 2018 by two brothers to kind of change the offshore market and the way that we charged, etc. And we've managed to organically grow since then with a 98% client retention rate and only 4 or 5 stars on Trustpilot. So do check us out, but I'm looking forward to getting this presentation underway and perhaps highlighting, as I said, some of these key issues and problems that expats in the US might face from a investment point of view. So without further ado, let me get to my presentation up. So as myself and Nigel have mentioned, SJB US, and myself will essentially be taking you through this presentation and what are some of the key aspects and common issues that are faced by expats. And I think there was kind of 4 key themes that we wanted to focus on today, because this is really what our clients come to us with some of the questions that arise and some of the issues that they do face, either on a daily basis or just wanting to educate themselves a bit more in regards to some of these issues. So some of these issues, not counting all of them, but these are, we think, the most important ones, which we find people perhaps have some further questions surrounding. So complexities surrounding reporting, that includes mainly overseas assets. So, the likes of ISAs, brokerage accounts, investments and assets overseas. How does that need to be reported on a US side? What to do with those overseas investments? So, after the reporting and everything along those lines has perhaps been cleared up, what to do actually from a taxation and investment perspective? Are those investments compliant? And other ways to perhaps mitigate some of those issues. More specifically, in regards to those overseas investments, I wanted to focus on UK pensions and the options that you have with those as well. And I think this is perhaps one of the biggest areas that we find people contact us about. Reason being, if you've worked in the UK for a large portion of your life before migrating over to the US, then it's most likely that this could be your second or third largest asset. So people want to ensure that they are set up correctly and invested correctly so that, they are aligned to their objectives in the US. And then just finally, I want to touch on a couple of areas from a domestic US perspective, ways to actually, perhaps diversify the portfolio of your assets and different solutions that you can use to help you achieve those objectives that you have financially, in a 5, 10, 15, 20-year period. Okay, so just, I guess, touching on the first one from a reporting and taxation perspective for these overseas assets. Now, I think there's probably 2 key areas for individuals to be aware of when handling kind of cross-border assets, especially those that are, outside of the US. One is something called FBAR, which is, foreign bank and financial accounts, essentially. And that is a requirement actually made by the US in order to stop US investors creating overseas kind of tax, tax havens, etc. So what they've been able to do is essentially get everything under their net for a reporting perspective, so that everything can come under their IRS taxation system. And for this, that essentially includes anything from, bank accounts, ISAs, most pensions, anything kind of investment related, etc. All does need to be reported on this. If the value of those combined assets are above 10,000, it's really important that they are. There could be hefty fines from a non-willing or a willing perspective that can get into the tens of thousands. So it's always worth making sure that you can report these. You can do it on a combined reporting perspective or separately, and it's always worth getting in contact with a tax advisor to ensure that that is correct. The second thing is actually from a PFIC rules, which stands for Passive Foreign Investment Companies. And I think this is one of the areas which is often overlooked by a lot of investors in the US. Essentially, this captures pretty much most overseas investments, including, the pretty standard ones like your ETFs, mutual funds, and REITs, which is, real estate investment trusts. So not direct property. These are essentially funds which invest into property on your behalf, and you receive earnings on them. So it pretty much covers, the majority of investments outside of the US. And what PFIC aims to do is actually tax people on those earnings, quite rigorously. It doesn't actually include foreign pension plans. However, you do still need to report them, and it's really important that they are reported. If you can get it reported correctly, then they may not come under the PFIC rules. But as a general, rule of thumb, the majority of your overseas investments, even cash accounts that are receiving interest, etc., they will come under FBAR, and if you hold mutual funds within them, then PFIC as well. How is that? How does PFIC actually tax these overseas investments? Well, a majority of them come under earnings. So when you create a distribution or a sale of asset, which might normally come under something like capital gains tax in the UK, under a PFIC rule, how the IRS see this is actually taxed as ordinary income, which depending on your earnings and your brackets can be up to 37%. What's also interesting about this is that they also add on pretty much a time of asset held type of distribution onto this. What that means is, depending on how long you actually have the asset, you will actually be charged interest for the amount of time that you've held it. So it's very easy to get these tax charges up and above near 50%. Actually, as you hold these investments. So it's really important to make sure that any assets that you've got overseas adhere to these PFIC rules by either making sure they're in PFIC compliant funds, or by moving them over to the US and actually have them under the US regulatory framework, because most investments within the US, of course, will just come under your normal rules from a taxation perspective. So this just aims to capture anything overseas and taxes quite rigorously on that. So it's really important to adhere to those rules. So off the back of these PFIC rules and considerations, well, what do I do with some of these assets that are overseas, and perhaps some of the key ones that I think our clients hold and want to get advice on now that they've moved over to the US. So the first two kind of link up slightly. So we have brokerage accounts. So you might have things like Interactive Brokers, Hargreaves Lansdowne, just normal brokerage accounts that you may have set up whilst in the UK with any spare cash, etc. It's really important that from a PFIC perspective, they're either in PFIC compliant funds, and it's a consideration to ensure that if they aren't, well, you need to look at the taxation of that. You need to look at whether, okay, if I was to sell or receive a distribution from this, then I'm going to be under these PFIC rules. So the idea is to actually, give yourself a bit of a trade-off with regards to, is it worth actually selling some of these assets, realizing the gain and moving them over to the US to ensure that they aren't going to be, penalized for having these overseas PFIC assets? Or, as I'll come on to with the ISAs, is it worth keeping them if you end up moving back to the UK? And that kind of brings me on to ISAs. And what's really important about ISAs and perhaps overlooked is that they're not actually recognized by the IRS. Even though there is the double taxation agreement between the UK and the US, the tax wrapper that the ISAs kind of give clients to the US isn't recognized, in the UK, isn't recognized by the US. And with that in mind, that means that majority of the actual funds that you hold within there may be considered PFIC, and then again, may be considered from a taxation point of view. If you were to receive a distribution or sale of one of those assets within it, that might incur a taxation charge, a quite heavy taxation charge. Whilst if you were in the UK and made that, as we know, ISAs are tax deferred and tax free on withdrawals. So it's important to look into whether, okay, if I'm going to be in the US for the long term, is this asset within the UK something that I'm going to need, or I'm going to touch, or I'm going to, move around? If that is the case, then it might be worth considering closing the account and moving it over to the US, where you might not be as penalized if you were to make investment changes within that every time from a PFIC perspective. If the plan is to only be in the US for perhaps a short period of time, and you plan to actually move back to the UK and come back, then it may be worth considering holding on to the assets but not making any investment changes. If they're all accumulation type mutual funds and you intend to just keep them and not actually create a distribution or sale, then it could be a consideration to keep that until you return. So I think the main objective or consideration for expats in the US really here is, okay, what are my long-term objectives here? Do I intend to stay in the US? Do I intend to move back in the short term? How does the taxation look for that? And then, go forth with the advice from there in regards to whether it is closing down the account or indeed keeping them until later on down the line. Next one is from a property perspective. What you need to look at here is, okay, we have two different types of property investments, or, property within the UK and US space. So essentially your personal or primary residence and your rental or investment properties. Property in the UK, if you're now living and migrated to the US, will pretty much just be seen as if you've got US property. And that essentially means that if you have lived in your if you can claim primary residence, if you were, let's say you've just moved to the US and you have a property back in the UK that was your prime residence for 2 out of the previous 5 years, and you wanted to sell it, well, you would then get preferential treatment in regards to that taxation on the earnings that you've got from that sale of the property. And generally speaking, you would get around $250,000 as a kind of deferment on the earnings if you were to sell that, if you can claim this primary residence. For a married couple or joint filing, that actually goes up to $500,000. So majority of the time, there may be preferential treatment from a taxation perspective, and you might be able to look into other areas to actually invest within the US market if you were able to do that. But let's say you had a rental, a rental property, for example. Well, there's no such treatment like that because it's not your primary residence. So the consideration here is, okay, well, is it better off actually continuing with just receiving a rental income, at which point, that is just ordinary income as you would in the US? Or is it worth, selling the asset and actually moving that into, some other form of asset within the US? And that's the consideration, is income versus another asset in the US. If you were to just move it to the US and have another rental property, then you need to look at yields on your investment, what your mortgage is, etc. as well. So the main consideration is, the taxation on the sale of the asset. Whereas, of course, with the rental, you're receiving the income. Personal, you may want to actually start renting that out. But then, within a few years' time, you might lose the ability to claim it as your primary residence. So you need to be aware of how that might be taxed if you were to, end up selling the property. Coming on to pensions. So, what do I do with my pensions overseas? What do I do with my pensions in the UK? Well, there's a number of different options that you do have, and it's always worth ensuring that you know where these are invested, to ensure that they're actually going to give you, the best outcome when you get to retirement. And that's, that's what I want to come on to next. So what are my UK pension options? Well, there's a pretty tight process that needs to be followed, I think, when understanding your UK pension options. First of all, you need to really understand what the type of structure is that you have. So the two main structures in the UK are defined benefit and defined contribution. Defined benefit is an income generating asset. So your previous company would say, okay, we're going to give you £10,000 per annum at the age of 62, inflation linked, and that'll be that. You'll receive that in your bank account every year, and that's the end outcome. Defined contribution is the more modern type of pension. You don't really see too many active defined benefit schemes anymore. Defined contribution is essentially a pot of money. So you'll put X amount of your salary away into one of these defined contributions, and your employer would also maybe match that, or even, if you're lucky, have slightly more contributions into that as well. So those are the more newer ones that we see, and they need advice specifically for each one independently. So defined benefit schemes, you have the option to transfer that asset into a defined contribution type of plan. The way that works is the company would actually offer you something called a CETV, and that's a cash equivalent transfer value. What that actually means is, okay, they'll base their calculations based on, what your final salary was, what the income is, a multiplier, and also some underlying factors like interest rates, etc., come into the fold quite heavily when calculating these CETVs. In recent years, perhaps prior to the interest rate rises this year, or the last 18 months or so, should we say, you might be able to get a multiple of, between 25 and 35. So let's say you were to get that £10,000 income every year. The company may offer you, 250, 300,000 to actually transfer that into a defined contribution type plan, at which point you're essentially substituting that fixed guaranteed income for a pot of money. So you need to consider whether, the benefits of having a flexible pot of money outweigh the benefits of a, fixed guaranteed income for life. And that's, it does take quite arduous process of actually analyzing. It is very, very independent of the individual's objectives, because of course, we need to take into account all your other assets, what other income generating assets you've got, and actually see, okay, well, from a defined benefit point of view, is it worth just keeping it where it is and having that stable income, or could you produce a better return from, a pot of money that you might be able to get slightly better returns above and over the inflation increases from a defined benefit scheme. But actually what we've seen over the last 18 months with interest rates rising is that these transfer values have actually decreased quite significantly. So again, advice comes into the fold even more importantly now, because whereas before it was a case of perhaps outlining whether the multiple was attractive enough to transfer, now you really have to dive deeper into the actual, softer objectives of how this asset sits within the rest of your financial objectives. From, a passing down of wealth perspective, is a defined benefit scheme the right way to pass on your assets, or is a defined contribution perhaps more flexible in that way? What options do you then have to actually, either consolidate or look into, what you can do with these assets? Well, I think one of the common myths is that you could just transfer it over to the US. I have a lot of people contacting us to say, okay, I'm looking at transferring over to the US. Can you help me with this? And the short answer is no. There's basically no way of doing this anymore. Reason being, if you wanted to actually transfer to the US, it would essentially class as a liquidation of assets, at which point you would be income taxed on the full amount. So, even if you've got, £100,000 or something along those lines within there, that would then be added onto your income tax return in the US. If you don't have the correct tax codes in the UK, you might also get taxed from a UK perspective. So it's really important not to just jump the gun and try and transfer stuff over to the US. The options that individuals in the US have are really two. One, leave them where they are with the current employers or providers, or two, a SIP, which stands for self-invested personal pension. Now, these offer a number of different benefits, but again, it's all about comparing and contrasting them to your current schemes. there's normally two categories that we find people fall into. One, they might know the value of what their pensions are, but perhaps don't know what the fees are, what the drawdown strategy or drawdown options are, where it's invested, what the performance has been. That's the first category. Second category is generally people that don't even have a clue, how much their pension is or where it is. Well, if you're in the first one, it's important to understand, as I said, these different factors. And is a SIP going to be able to give you, more flexible withdrawals, better currency benefits in regards to if you want to invest in dollars, for example, allow you to perhaps get advice in the US. A lot of current UK providers don't actually allow overseas advisors to give advice. So you may have to transfer if you did want to actually get continual ongoing advice on those assets. So consider a SIP if you are in the category of not really knowing too much about your pension or don't know how to manage it ongoing or understand how to actually draw down it in the most tax efficient method. You might want to consider a SIP and actually get advice on those. But from a perhaps non-private point of view, so looking at actually state pensions, right? Often individuals, try to ask things about, am I still eligible for UK state pension and things along those lines? And one of the first things that we actually help our clients with is actually trying to maximize some of these state pension benefits. And this is actually a real, golden nugget of knowledge, we think, because the UK have actually allowed people abroad to make something called voluntary contributions. And if you're employed as an overseas worker, so you're in the US, you just have a normal job, you can actually apply for something called Class 2 contributions. Now, what that means is you can actually put back in £3.15 per week into the state pension UK system, not affecting your US system, but you can put that in every week, so £180 per year. And that will actually buy you one extra year of UK state pension benefits. So if you've got 10 years of eligibility for the UK state, which is the minimum that you need, the maximum is 35, but you've still got, say, 15 years left to retirement or left to the age of 67, well, you could actually use those 15 years of additional voluntary contributions to get yourself up to 25 years and, pretty much double your annual income from a UK state pension perspective. And we feel that that is a really important factor for actually giving people a really cost-effective way to increase their retirement income. So if you wanted to know more about that, then please do let me know, because we can send some information on how to start that process of actually finding out, how much you've got currently as a forecast and how much it's going to cost you to actually continue to, contribute up until retirement. So from a, I guess, more domestic side, so we've covered a UK perspective and overseas perspective and some of the key questions and themes to think about there. But what about from a US perspective? What can you do to perhaps maximize some of the US financial systems, to ensure that you're getting to your retirement income as quickly as possible? Well, there's a number of different ways. The more pretty standard vanilla options are things like your pensions. So you've got two different options from an IRA perspective. You have a traditional one, which is actually funded by pre-tax contributions. So that's actually set to increase from a contribution limit up to 8,000 in 2024. Generally, they increase each year, due to inflation, etc. So if you're over the age of 60, you can actually contribute up to about $8,000 into one of these pre-tax IRAs. You also have a post-tax one. So this is called your Roth IRA. So this essentially allows you to put in your post-tax capital, because ultimately, if you think about it, similar to an ISA, you can put in post-tax capital and you can get tax deferment from that as well. So the contribution limits are exactly the same for both. But you can use both in tandem and be able to, build up some of those retirement assets. The one that probably most of you are most aware of is the 401k. So that's just, a qualified employer pension where your employer might contribute and you'll also contribute to that as well. There is contribution limits on that as well. And that's set to increase if you're 50 and above about $30,000 US dollars. That's just for you as an individual. So of course, if your company puts some in as well, then that is above that limit, which is fine. So it's just for your own contributions. That's going to increase if you're 50 and older to about 30,000. It's about 23 and a half if you're under 50. So just be aware that there is different contribution limits under and over 50 that you need to adhere to. You then have, let's say you have some surplus income. Okay, so you've got surplus income, you've maxed out all your pension contribution limits. Where do I put my money now? Well, you have a couple of different options. One, the pretty standard one, is your brokerage accounts. So you'll be able to see here that, there's no contribution limits. There's no, obviously, tax breaks when it does come to these. So, you can be taxed as, your capital gains, depending on how long you actually hold those assets. But those are perhaps the easiest option for individuals wanting to start investing. So, you can open a specific trading account where you can just start either trading stocks or, your mutual funds, etc. We would always say, for, your basic or average investors, you're probably best off using, some large, fund of funds or things like that to actually allow you to kind of minimize the amount of trading that you have to do. So give it to, your larger funds to actually be able to invest on your behalf, like Vanguard, BlackRock, etc., those sorts of big players. When you start to day trade, it can be quite difficult, especially if you've got a day job as well. So leave it to the professionals. But you do have other options, if you want to look into child accounts. So let's say you wanted to start you want to start putting money away for your child and actually be able to, give them a head start. As we know, US universities are pretty extortionate, especially compared to other countries. So you want to be able to actually give your kids the right start to life. And you can actually look at some form of a child account. So you can have your UTMA or your UGMA. Bit of a mouthful that, but yeah, you essentially have two different types of child accounts when it comes to uniform transfers. So the UGMA, is your pretty standard, just stocks and bonds. So no physical assets, whereas the UTMA actually allows you to hold physical assets. So such as property, art, all those sorts of things you can actually have within there as well. The most common one is just the stocks and bonds because it allows you to invest the money within that. And there's no tax deferment or anything with these types of accounts. So they will be taxed essentially as normal. But then you also have the 529B account. So you can, from an inheritance point of view, you have contributions that you can put in about up to 17,000 or 34 if you're a joint, filer when it comes to taxes. But that's just from a gifting tax perspective. So if you could put 34 in, that just gives you the break from a gift tax point of view. But there is no contribution limits when it comes to 529Bs. The benefit of the 529B is actually from the tax deferment point of view. And that's why it's probably more sought after than perhaps your other accounts like your UTMA or your UGMA, because it allows you to not have a contribution limit, but it also allows you to take out the capital tax free if you do use it for educational expenses. So, it's a really good way of contributing to a plan, putting some of that surplus cash to give your kids the best start from a debt perspective of helping them out at university, etc., or whatever they plan to do from an educational perspective. Perhaps some of the ones that are perhaps overlooked or not really known in the retail space is something like insurance solutions, which we find have been really popular within the kind of US space. And that's using different types of annuities depending on the individual's objectives. So I think from a UK perspective, annuities was always thought as, I'm going to give my money to an insurance provider and they were going to give me a fixed income for life. Whereas the annuities industry has kind of changed. And also in the US, it's come along a lot further. And what you'll find is different types of annuities. For example, one that seems to be quite popular is something like fixed index annuities. What that entails is essentially where the annuity is based on an underlying index. You might have capped earnings. So let's say it was tied to the S&P 500 performance. They might have a cap of say 7% on the annuity. So if the S&P was to go up 10%, you would only receive 7%. But a lot of the benefits of these is that there's often flaws on the actual performance from a negative perspective. What that means is, okay, well, let's just say the S&P drops 30%, which of course we know it has. Well, a lot of these insurance solutions actually allow, a cap of how low it goes, often at 0%. So it allows you to invest in a way which is perhaps not giving you the full benefits of the reward, if markets are doing really well, but it gives you, a bit of a strategy from a loss point of view to actually allow you to really cap the losses that you have. And that's why we feel that having those as a separate type of investment have actually been pretty popular with individuals in the US. And of course, I think one of the biggest ones from a US perspective is property, right? So whether that again be rental or primary residence, looking at rental properties can be a really good way of getting you, a set income by the time you actually do retire. And we find that there is a lot of good opportunities in the US for this. Of course, we've had interest rates rising quite a bit, so mortgage rates have of course increased as well. But the consideration is, okay, well, if you can get a good mortgage rate, but also get the opportunity of potentially a low type of value property that can give you a good yield, well, then those are options that you also need to look at to diversify the portfolio. So it's important to utilize all of these different structures, utilize and maximize your contribution limits where you can, utilize the different taxation of the different assets. And it will really allow you to get ahead of the curve when it comes to retirement. I mean, the annuities are tax deferred as well, so you'll be able to use your taxable brokerage accounts, your taxable UTMAs, but then also use annuities that might be tax deferred, as well as your 401ks and your traditionals IRA to really allow you to get up to that retirement pot that you actually intend to get. So just, I guess, some final thoughts in regards to what we think clients or individuals in the US should think about. Well, it's really important to understand the taxation on your different assets. We think that this is, from an actual basic level, is the first port of call that individuals need to do. So whether you're migrating over to the US or you're already there, if you've got assets in the UK or elsewhere, it's really important that they are compliantly invested, that they're reported correctly, and that you understand exactly how these are seen by the IRS. So it's always worth getting tax advice on that. Again, comes on to that next point. Reporting is not to be taken lightly. It's absolutely paramount that you report all your assets compliantly and invest them accordingly based on those rules as well. What we found that in regards to overseas structures, we found that often they can be improved, whether that be from a pension perspective, again, using ISAs, brokerage accounts. If you've got various different overseas asset structures like trusts, etc., as well, it's absolutely worth getting a second opinion on these, just to ensure that they are either, compliantly invested, as we said previously with the IRS rules, or just from a structural perspective, that they actually are in your best interest from a drawdown or cost perspective as well. There's often greater opportunities out there now that you are in the US, in regards to, in comparison to previously when you may have just been in the US. Again, from a PFIT perspective, absolutely paramount you're aware of how all of your outside US assets are seen by the IRS from a PFIT perspective. If you aren't aware, get a second opinion, seek professional advice. And I think that's perhaps culminating into that final point there, is that if you do have any considerations or issues that you are facing, or you're just unsure about how a certain asset is taxed or seen by the IRS, then absolutely seek professional advice if you really do have a lot of questions, because as I'm sure the longer you live there, you'll realize how much the IRS likes to have their fingers in all the pies and understand where everybody's assets are. So it's important to just understand that and make sure that you are adhering to all the rules. So we are here to help. As I said, we are cross-border specialists. Our niche really is in ensuring that people understand how the UK and the US join up and see each asset differently. So please feel free to reach out. ask us any questions that you do feel the need to, and we'll be able to, at least have an introductory call or a discovery call just to see if there are areas that we can help with, and really, give you guys the peace of mind that you're either making the right investment decisions or just getting a second opinion in regards to how things are invested, or how the taxation works on those different assets as well. So appreciate your time. And yeah, if you do have any questions, then please feel free to fire them my way on that email, or contact us directly for our website.
Okay, well, thank you very much, Robert. Can I just start off with a quick question from myself? And I'm not in any way advocating anybody trying to break rules or whatever, but you talk about the reporting, and that it's very important to comply with that. How do the US authorities actually know what you got if you don't report them, so to speak? How would you get sort of caught out, if you like?
Well, I think there's a number of ways, isn't there? At the end of the day, there's now the you have FATCA, which is essentially it's basically a task force that's allowing all international bodies to actually speak to each other in regards to assets that you might have. So any financial institution now has to actually perhaps report on some of those assets if this individual is abroad. So whilst you might think you're flying under the radar, it's better off getting ahead of it before, rather than getting penalized, thousands of dollars later on down the line. So yeah, as much as you don't think that these international authorities speak to each other, I think especially over the last 6-7 years, since this FATCA, et cetera, has come into force, it's become, quite a big issue for individuals with these overseas assets.
Okay, well, clearly my motivation was to make people realize about their things rather than to think they could get away with
it. Good. Yeah, definitely can't.
Okay. You mentioned ISAs early on, and the question here was, are you allowed to continue to invest into ISAs when you're not resident in the UK?
Short answer, no. So, most UK providers, whether that be pensions or ISAs, probably won't let you continue. You might be able to try, but if they know that you're in the US, there wouldn't be really any benefits to doing that. There may be more tax efficient areas to do it within the US rather than continuing to contribute to the ISA. So for me, I don't see any benefit of doing that if you've got, the contributions, limits, etc., that you've got in the US to perhaps give you those advantages that you're looking for from an ISA perspective. But it is very provider driven as well. We find that a lot of providers in the UK and vice versa, really, actually don't particularly want to touch people in the US because they have to do certain reporting or extra reporting as well. So just look into that and adhere to the rules that your provider sets out as well.
Okay. Another question we've got here, asking whether if when living in the States they need to have a US and a UK will, or will one will be sufficient across both the UK and US assets?
Yeah, it depends how it's set up, but most of the time your UK will be able to cover both assets. So as long as you've got that up to date, then so we actually use a will and trust planning individual who actually can assist with that. Depends how you set your will up, but make sure that it's always updated to include your US assets. Of course, if you're UK domiciled, then you'll come under UK inheritance rules. So if you do have a UK will, then that should allow you to cover all your assets in the UK and the US.
Yeah. And from previous webinars, I just emphasise that UK domicile, that it can be a devil to lose your UK domicile. And if somebody is sort of thinking about, being able to pass on their assets without having a UK domicile, it's something that they should really look into to understand what fairly minor things like having a burial plot can lead to you still retaining your domicile. Is that not right?
Yeah, absolutely. Yeah, I mean, the US, I think, probably has slightly more favorable inheritance rules, but and I think that's why people moving over to the US just think it's maybe where they're based rather than this idea of domicile, which, yeah, as you said, is often hard to shake. One of the main main points of domicile is origin, where your father was born. So You know, in the majority of cases, if you're British born and your father was born in the UK, then, as you said, it's very hard to actually shake that domicile of origin. So when it comes to trust planning and everything like that, you know, it's important to look into those rules from a UK domicile perspective, rather than just thinking, oh, because you're in the US now, everything is under their inheritance rules. Yeah, it doesn't quite work like that, unfortunately, in practice.
Another question here: how does the social security system differ to the UK, and can I still claim both?
Short answer to the second part is yes. So yeah, you're still, as long as you've obviously got the minimum amount of years in both, then yes, you are still eligible for it. The way that the system works in the UK, of course, is that you just have, you know, yearly, you know, state social security payments that come off your salary often, and that will just give you an extra year of contributions. 10 is the minimum, and then you can just carry on up to 35. Differs slightly to in the US because it's based on a credit system, so it's actually sometimes based on how much you're earning. If you're, you know, a slightly higher earner, you can get up to 4 credits a year, and you need a minimum of 40 credits to actually get the minimum benefit from a US perspective. The actual figures are quite different as well. So from a UK perspective, you know, the maximum is about it's just gone over £10,000 per year now, whereas the maximum in the US is near and around, you know, 30,000, if it 30,000 US dollars. So, you know, the disparity in it is quite large in regards to what you could actually expect to get.
Okay. And another one here. The questioner says, I'm looking to use a trust in the US for IHT benefits. Would any issues arise from the UK side over this?
I guess this comes back to our short conversation earlier, Nigel, in regards to domicile. And I think that's something that really needs to be looked into when looking at trust planning in the US. Because, you know, if you were to make, you know, a large contribution to, let's say, a US trust, but, you know, in practice, you're actually UK domiciled, you might be hit with some, you know, unforeseen inheritance tax issues from the UK side. So it's always worth getting full tax advice prior to actually just setting up a US trust with an advisor, etc., because that is the key question here: is, am I UK domiciled? And from a trust planning perspective, would I get taxed either from something called a chargeable lifetime transfer, depending how you set it up? If you pass away within 7 years as well, there might be an additional, you know, 20% inheritance tax charge on your contributions to that trust. So ensure that you get that question on the domicile before setting up anything in the US from a trust perspective.
Right. Okay. Finally, many people have UK financial advisors, and you know, the question is, can they still look after them once they move abroad to the US?
It really depends on the advisor's licenses, I guess. So from a UK perspective, they can absolutely advise you when you're in the UK because they're FCA registered. Whereas when it comes to the question of now that you're in the US, what the advisor needs to have is the relative licenses to be able to actually advise you as a resident of the US. And that means they need to have an SEC specific license to actually give you advice as a resident of the US. Doesn't matter even if they're looking after the UK assets. It depends on where the actual individual is based, the client is based. So if you've moved to the US, you'll most likely need to actually find a US based or US regulated advisor that can help you with, you know, things on both sides of the pond.
Okay. Well, many thanks, Robert. I think we'll call it a day. There's no further questions there.
Yeah.
And so just to finish off, thank you all for listening. And as Robert said, we're here to help. So if you have any questions, you can either use the email address that Robert's got there, or you can send it to us and we'll pass it on. And the address there is expats@expatnetwork.com. So thank you for joining us, and good luck with your move to the States or your continuing life in the States, and hopefully financial security as part of that. So Robert, thank you very much, and bye everybody. Cheers.
Thank you. Bye.
Bye.